The stock of the day. Henry didn't keep anybody in much suspense for very long, but that's okay. It has reported third quarter cash profits of $2.7 billion, down 1% from the first half average, but up 4% year on year. So higher lending and deposit volumes offset rising economic pressures from, well, multiple interest rate increases. It said operating income was broadly flat in the quarter as growth in lending and deposits offset the impact of 2 fewer trading days and continued competition in home and business lending. Shares are down about 10%. Interestingly as well, BHP yesterday surpassed CBA as the biggest company on the ASX by market capitalization. So is this sell-off that we're seeing reflective of that 1% fall in quarterly profits, or is it more to do with just general consternation about the the growth or the slowdown in growth that we could see in the housing market when it comes to some of these tax changes that have been made coming from the budget? Henry?
Nadine, I do a joke every time I present to the ASA talking about the film Hot Fuzz. And the joke is, how this kid goes into a bar and the barman asks him how old he is. And he says, 18. And they said, when was your birthday? And he says, every year. And that is the thing with these banks. They make $30 billion of profits every year. But the problem is that $30 billion isn't actually increasing. And that is the problem. So they're not growth stocks, but yet they're priced as growth stocks. Commonwealth Bank is still priced, even after a 9% fall and giving up its mantle to BHP. It is still being priced for growth as opposed to stability, conservatism, and certainty of earnings. And they're not really in the dividends, in the income basket as well, because when you've got bond yields where they are, the average bank yield is now below the bond yield. So they're not growth, they're not income, and we've seen the 3 B's at play with Commonwealth Bank today, which is bad debts, which are rising, the budget, which is obviously detrimental to the housing market to some extent, and it is some of the analysts are saying that Commonwealth Bank and Westpac are the two most likely to be affected in the long term. And the third B is they're blooming expensive. And those 3 B's are contriving today to push this stock down nearly 9%, which is extraordinary. My big bank basket, which I rabbit on about for a long time, it peaked at $310. It's now down to $265. And the big resource basket, which was trailing not that long ago, about a week or two ago, by $50, $60, $70, $80, is now above the big bank basket valuation. That's just the 3 iron ore miners stock prices added together. So there has been a massive turnaround, and you can see that today. BHP hitting all-time highs, CBA plummeting nearly 9%, and another one of the C's in a sea of trouble. We've seen CSL, we've seen Cochlear, and now we've got CBA. The sea of trouble is not good for these guys at the moment. So interesting move today, that's for sure.
Yeah, so this is a funny one, though, when it comes to stock of the day in this program, because it's a buy, hold, or a sell. We know that most people never sell if you're talking retail investors, and I hate that term, but they don't sell CBA. But what would you be doing after a day like today when it's down with the the rest of the C's, but I guess lesser so, down by about 9%?
Well, I certainly wouldn't be selling. You're going to be holding, and as most investors will be holding this, till Charlton Heston gets the rifle price out of his cold dead hand. So I don't know what effect tax changes are going to have on people's perception of this one, because pre 1985 tax changes, all that sort of stuff. So it's going to be interesting how it falls out. But from a stock price point of view, it's taken a big hit. And I think, you probably should have sold it a little while ago. I think it's not going to perform brilliantly, but having said that, you don't want to be throwing this one out on a bit of a panic. So I would be holding this one for the time being, at least.
Yeah, so Andrew, I'm sure some of your clients have CBA in their portfolios. Probably a lot of them had them before they met you. So how do you advise them now when it comes to CBA?
Shocking, Nadine, isn't it? No, they would have bought them at $5.40. It's an interesting point Henry just raised there. Well, there's a number of interesting points, but in particular that CGT pre-85 discount disappearing. I think that's next year from memory. That's going to be a really interesting one because, as you said, there was no incentive before to sell them. But if now that window is closing on people, that may in fact get some people to sell them. So that's certainly something people will be needing to turn their minds to. I think the thing that spooked the market was that increase in bad and doubtful debts that Henry just alluded to, $316 million provision. Remembering that, you know, the outstanding loans for CBA is well in excess of $100 billion. So, you know, the number of people going bad or, you know, CBA are expecting to go bad is like 0.00 something percent. In other words, 99.9% of people are paying their loans back on time. But when you are priced to perfection, and with this macro environment that we're facing, rising interest rates, concern about the Middle East, changing regulatory environment, you know, that potentially there is increasing sovereign risk. The government says they're not going to change things, and then they do change them. That has the market spooked. I think the other thing, Nadine, is that at the ASA conference, of all things, when I was talking to one of the presenters at the panel that I moderated the next morning, and he pointed out to me that there's a lot more hedge fund activity in the Australian market globally, and they're using gearing. So in other words, they're borrowing to buy Aussie shares, and if the results are great, well, you don't see them getting out. You know, they just sort of gradually knock off little bits along the way. But if things aren't working, CSL, Cochlear, all the C's that Henry was just referring to, these hedge funds are just brutal and will just sell it. They'll stop it out immediately. So I'd suggest there's probably a little bit of that going on as well. But look, it's a hold for the time being. I think from a technical point of view, it's around that $148, $150 mark. If it can bounce off there, it's actually probably a buy. But at the moment, it's a hold.
Okay, got it. Thank you. That's CBA hold from both of my guests.